Yeah, we're going to take a look at earnings and structuring a collar position around your stock heading into earnings. Got a lot of big names reporting tonight, and I'm going to use Alphabet or Google as the example here. So remember what your choices are if you own an individual stock like Meta, like Google. Choice one is you can ride them every quarter into an earnings announcement. You've got open-ended upside, you've got open-ended downside. And if you get a response like Meta, you'll be like, listen, I don't want to cap my gains ever. I want the upside. The problem is go look at Meta's last earnings announcement and it got destroyed, right? And so either you are comfortable with the size of your position, it's a small enough amount of your portfolio and to where you're willing to ride it open-ended into every earnings announcement, hoping that over time there's more good than bad, or you structure some kind of option position around your stock heading into earnings to have defined outcomes, more limited exposure. And the strategy that's most appropriate or maybe potent in accomplishing that is known as a collar trade. It is, I'm going to take some notes here. It is nothing more complicated than owning 100 shares of stock, selling a call option, typically out of the money. Okay, that's your covered call. So you're going to cover the stock, and you're going to buy a protective put. You're going to buy a protective put. And when you look at the risk graph, as the name collar implies, you're building something around the stock, and it defines the outcome. So, for instance, if I'm long stock at $100 and I buy a 95 put, I've got the right to sell the stock at 95. So buying the put option is buying insurance, and it limits the downside. Okay, now I'm capped at, in this case, losing $5 in the stock. And then to help pay for the put, to help finance the purchase of the insurance, you're going to sell typically an out of the money call option. Like, let's say I sell the 105 call, and I'm going to get paid for that, which is the reason I'm doing it. But there is an obligation I'm under, and I'm obligating myself to. I said this wrong. I'm sorry. I have the right to. No, that's right. Sell stock at 95. I'm also obligated to sell stock at 105 with the call option. Well, think through those two things here. If I own the stock at 100, I'm obligating myself to sell it at 105, and I got the right to sell it at 95. So I've got two outs now, two defined exits, which cap my gain but limit my loss as well. Conceptually, that's how it works. If you look at Google, okay, if we look at Google, first of all, I mean, Google, you got a gift today. Okay, the stock market actually responded to Meta earnings in part by giving Google and Amazon, okay, as well as Apple, the benefit of the doubt going into earnings, right? They are essentially looking at Meta and saying, hey, Meta was great. We're assuming Google, Amazon, and Apple are going to deliver. Why wait? Let's jack their prices up 6% today. So if you owned Google, you got your 6% pop. Suppose now going into the announcement, you're like, all right, well, what if they screw up? There could be a down gap, right? I want to define my outcome here by doing some kind of collar. Well, if you take a look, you have lots of choices in terms of what expiration to use. I'm just going to use the front month, basically 2 weeks out. And you got two choices. One is where do you want to cap the gain? And two is where do you want to limit the loss? And you can skew the collar. You can create one that's a little more protective or one that's a little more offensive and has more upside. I would say that I don't like capping the gains too quickly on every earnings announcement. I do believe that if you like the company, a lot of the gains that you're going to get over time come through earnings announcements and earnings responses. And completely stripping that out from your performance might be a little short-sighted. So my personal bias is to not cap gains going into earnings. to have a small enough position where I don't feel pressured. Like, oh crap, there's earnings coming up. I got such a big position, I better protect myself. Sometimes just having the right sized position is a more elegant solution. Okay. But if you feel so inclined to set up the caller, in the case of Google, I got a lot of out of money strikes to choose from. Suppose I sell the 115 strike. I say, all right, I'll sell a call that's $8 out of the money. I'll cap the gain at 115 because I don't think it's going to go that much further. And effectively, what I'm going to do is I'm going to take that $1.60, $1.65, and that's going to help finance the purchase of an out of the money put. By the way, right now puts are quite cheap in Google, in part because it seems like everybody after today's like, don't worry about it, right? Meta said everything's fine. There's not much demand for these out of the money puts. I could take that $1.65 credit and I could go buy a 100 strike put for the same, effectively the same dollar amount. And so it's no out-of-pocket cost. The premium from the call paid for the put, they refer to that as a no-cost caller. So if you look at that on a risk graph, it's actually quite interesting. So I'm long the stock. I'm going to buy this Feb 100 put. I'm going to sell this Feb 115 call. And again, $1.68 credit pays for the $1.60 debit. If I analyze all three of these, you're going to see the net effect of adding that call and that put. So absent the caller, you're just vanilla long stock graph, unlimited upside, unlimited downside. And you're uncomfortable with that because you don't like the unlimited downside piece. So you're like, hey, I'm going to buy a put, I'm going to pay $1.60. You could just do that and be done, I suppose. But if you don't want to pay for the put, you're selling an upside call to help offset the cost. And so now you have defined outcomes. Your risk is limited under 100. Your gain is capped above 115. And it actually turns your trade into a bull call spread. So a caller is a synthetic bull call vertical. It's also a synthetic bull put vertical, believe it or not. But defined outcomes, right? Defined outcomes. And where you may be able to shift this a little bit is you just deciding, are you okay with 115? Do you want to have maybe a little more upside and push your short call up to 120, right? And skew it a little bit more bullish. I don't know that you really need to go much further out of the money. That 100 put was cheap enough at $1.60. I think you're fine. But this is where risk graphs come in handy, is you can model a couple different variations and decide which one has the best trade-off of cost versus where you're capping the gain and what you're paying for the put. And then you can kind of zero in on the proper structure. The key, again, if you're going to do a caller, you got to have one short call, you got to have one long put, and 100 shares of stock. This is an example on Google. I think it's a great example. You could take the same principle, final point here, and you could apply it to Apple. You could apply it to Amazon. You could apply it to Ford if you wanted to have the more defined outcomes.